Hey everyone, me Kevin here. In this video, we're going to review 12 reasons why the market is falling. We're going to go through each one independently and share some facts and opinions. Let's get right into it. Right after I mention that this video is brought to you by Titan, but more on them in a moment. You can see a link for them right down in the description next to the links for the programs on building your wealth. And of course, a sign up link where you can sign up to learn about any potential future funds that I might announce by going to metkevin.com/cashflow. Check out those links down below. Okay, number one. Scary bubble market indicator. Folks, 36% of NASDAQ stocks are down 50% from their highs in November. The NASDAQ is down 8% from its highs in November. Usually, when the NASDAQ goes down by 10%, only about 12.5% of stocks are down 50%. So the fact that 3 times as many stocks are down 50% is potentially a bad sign. This means that really mega caps are the ones keeping the index up, and that faster growing, smaller companies are getting wrecked under higher interest rate fears. And unfortunately, this could usher in a quote, cyclical bear market, where we see indice declines of at least 20% from the records set in the last few months. Since 1972, there have only been 39 days, though, where the NASDAQ was within 10% of highs and 35% of its members were down 50%. That is, out of the last 50 years, there have only been 39 days in the past where the NASDAQ has been down roughly 10% and 35% or a third of the members are down 50%, which is what we're experiencing now. And folks, all of those days happened in 1998 and 1999, right before the bubble pop of 2000. Now, there's a lot of pain in the microcap sector, so who knows, maybe this is just isolated to microcaps and shorting, but it's not a very positive sign. All right, that's market reason for pain number one. Number two, bank earnings. First, Citi reports that corporate client balance sheets are very strong, that there is a lot of liquidity on both consumer and corporate sides, and that a lot of business investment is being conducted, a lot of CapEx spending, especially to streamline supply chains. The issue, however, is that we are in an era of unprecedented and unanticipated demand, and as a result, shortages. This comes at the same time as consumers have low delinquencies and high payment rates on debts. And Citi is seeing positive deposit growth despite a reduction in stimulus. This all was actually relatively positive from Citi, though we did see trading and loan revenues decline. This is similar to what we saw at Wells Fargo and JP Morgan. In fact, Wells Fargo reported that there's a huge amount of corporate liquidity in the system and available. They also say that there is 30 to 35% more money in individuals' accounts for all wealth levels than prior to COVID. But, and this is the downside, and this is the part that's really weighing on the market, Wells Fargo says that inflation is very real, prices are up for most, that businesses have the most pricing power that they've ever seen, and that really labor and wage shortages are just contributing to the issue. JP Morgan reiterated this sort of inflation as well, going as far as saying they will pay whatever it takes to attract the best talent. Goldman Sachs just paid out massive bonuses to their top 1% of workers to retain their best talent. JP Morgan goes on to say that wage inflation is real and that we should expect higher inflation for 2022. In fact, we're regularly seeing revisions up on inflation estimates. The big issues here, folks, more inventories are not actually at the moment helping reduce inflation, they're helping increase inflation. This is quite wild because the Cathie Woodian argument is that as we have more inventories, businesses will have to cut prices to get rid of those inventories and actually move product. But the flip side is that as businesses continue to build up their inventories, what happens? You end up putting more pressure on manufacturers, leading to more inflation and supply chain constraints. Now, trying to prevent getting, quote, burned by businesses is what's inducing this sort of spending on more inventories because businesses do not want to be caught flat-footed without the appropriate levels of inventory. JP Morgan is expecting less deposit growth, but the theme of these three banks is very simple. Defaults on loans, very low. And people have money. But because defaults are low and people have money and people are able to get more credit if they want to, which means they have more money to spend, we are seeing people willing to pay higher prices, and this is leading to the cycle of inflation continuing. So we're in this sort of weird place where we have higher profits, lower delinquencies, but all at the expense of prices going up. Now, Goldman Sachs recommends that now's the time for investors to check out financial stocks, energy stocks, and material companies, as these might be the best suited for hedges against inflation. Now, let's talk about these business inventories, and this is the third problem. But first, a message from our sponsor, Titan. Link below. Thank you, today's sponsor, Titan. It takes a lot of time to keep up with everything going on in the stock market. I know, I spend hours every single day researching everything that goes on. And quite frankly, this is where Titan can help you. Titan is the first investment platform for everyday investors that want their money actively managed by a team of experts. They do the research for you, so you don't have to spend hours or reading articles and understanding the Federal Reserve reports or stressing out about the minutes. Oh my gosh, the minutes. Having someone else manage your portfolio can save a lot of time and a lot of stress, and you can get started for as little as $100. They even offer an actively managed crypto portfolio, so even if you're not a complete expert in crypto, but you want exposure to crypto, they can take care of you. The Titan team can manage it for you. You'll even see exactly how your money is managed through their video, audio, and written updates through their proprietary mobile app. Right now, if you use my URL, titan.com/Kevin, you'll get your first 3 months of investment management totally for free, 0 fees. And you can now join the smarter way to invest with Titan. And all it takes is clicking that link down below or going to titan.com/Kevin and $100, and you can get started. Remember, that's titan.com/Kevin. For 0 fees. Business inventories were announced today to have jumped 1.2% in November. Now, business inventories are usually a sign of an expanding economy adding to GDP. However, the fear now is inflation. As businesses continue to stock up on these inventories, now 2 months in a row of inventories increasing, we are seeing more pressure on supply chains, which is then getting compounded by Omicron pressuring supply chains. So ironically, as business inventories go up, and that should be good for GDP and should be good for potentially prices going down, right now, prices are going up before they come down. And this is also true in the energy sector. And this is the number 4 reason for why the market is having such issues. BlackRock says that the number 1 investment opportunity going forward is investing in new technologies, especially around the green economy. Now, this came from the BlackRock earnings report, and they mentioned that new technologies are going to help accelerate the transition to green. But the problem is, until we actually have the innovations that we need in the green space, we can actually see the prices of green energy go up rather than down. And it comes at the same time that so far year to date in the last just 2 weeks, since the year is only 2 weeks new, oil is up 10% this year. Natural gas is up 7 to 20% depending on which type. Aluminum, nickel, and iron ore are all up over 5% just in the last 2 weeks. And while some of this could be due to trading, these moves are perpetuating fears that prices will keep going up, that energy costs will keep going up, and that the green energy revolution can't keep up because of price ceilings and the time it takes for new technology to actually help bring green energy costs down. So in other words, we might be dealing with high fossil fuel costs, but also high green energy costs. And this is a potential negative catalyst because as you look around and you see that all opportunities for energy prices are going up, your opportunity to lower inflationary pressures actually goes down. So in other words, more energy costs both in the green and hydrocarbon space, more inflation. Now, one potential diversifier here is investing into something like the CraneShares Global Carbon Strategy ETF. They bet on carbon futures, which is similar to having like call options on the price of carbon. As the price of carbon goes up, so should this fund. No guarantees, of course. But anyway, this fund was created in August of 2020, and it's up over 100% over the last 12 months. It really is. It really has been acting as a diversifier, especially to sectors like big tech and other aspects or higher growth sectors of the stock market, which have been getting substantially punished. So another issue to keep in mind: higher energy prices hurting the market. Number 5, consumer spending. So the headline here is really FUD. It's a sign of pain. 1.9% decline in retail sales. We were expecting a 0.1% decline, so we had a big miss here. 10 out of 13 categories declined. The only categories that were positive were home improvement, health and personal care, and miscellaneous stores. All the others like clothing, sporting goods, food and services, cars, retail, online retail, electronics were all down. Online fell the most, 8.7%. Not good for Etsy. Etsy got burned a little bit in the stock market today. Etsy's now down over 20% year to date, and we've only been on the market for 2 weeks here. Kind of crazy. But anyway, October and November results were so strong, though, that if we look at Q4 broadly, Q4 retail sales are still up 17.1% year over year. Problem is, none of the headlines in the mainstream media are talking about how Q4 retail sales are up 17.1%. All they care about is that December is down 1.9%. So, unfortunately here, we have fun. Now, it's unlikely that inflation is actually what held back spending because people have more cash. It's actually presently appearing that it's more likely that demand was just pulled forward to October and November rather than December, as people wanted Christmas gifts to actually arrive timely or holiday gifts to arrive timely. Either way, this headline report is affecting the market quite negatively. Number 6. The Russia and Ukraine drama. Russia currently has 100,000 troops lined up next to Ukraine with tanks and artillery ready. NPR interviewed a retired colonel who thinks that the odds of a Russia invasion are 8 out of 10, with 10 being the most likely. Now, look, it either appears that Russia here is saber-rattling or they're getting serious. You do have the White House and Democrats arguing that there may be false flag operations that could actually perpetuate the odds of an invasion in the Ukraine. The Biden administration has gone as far as saying that Russia is literally considering saboteurs to attack their own forces, hence a false flag operation, so that way Russia can use this as evidence or a reason to end up attacking the Ukraine. Now, the White House didn't release details of this evidence, but it seemed to be related to intercepting communications as well as drone or satellite observations to corroborate that information. Some are calling this claim of a false flag misinformation itself, especially some individuals on the right who are saying that, of course, the Biden administration is saying that now the Ukraine and Russia Russia is setting up false flag operations. Because, see, the 4D chess kind of level here argument would be, okay, well, if the Biden administration wants to downplay Russia invading Ukraine, then maybe the Biden administration could say something like, oh, well, that catalyst for the war was just a false flag, so that's not actually a legitimate invasion, and so we're not gonna, get involved on either side, or something like that, right? So really, it's like, who's right? Nobody knows. Military is a disaster, but this uncertainty is certainly leading to more pain in the market as well, especially since there was a cyber attack that just downed multiple government websites today. The government of Ukraine does say that there was no data leak, just a crash, probably a DDoS attack here. The U.S. is advising that they're helping the Ukraine deal with this. Remember, folks, this issue has been going on for quite a while, not only with the Ukraine going as far back as 2008, 2009, but in 2014, you had the Malaysian Airlines flight that killed 298 individuals because of a Russian missile that was shot somewhere from the eastern border of the Ukraine, which is right next to Russia. So it's suspected that a Russian warhead destroyed this passenger plane, killing 298 aboard, flying above the Ukraine. The same year, by the way, Russia invaded Crimea. Biden right now saying he will not send troops to defend the Ukraine. Instead, he's going to help reinforce military presence with NATO. And this is hotly debated, mostly because the Ukraine is not part of NATO, but many say that the Ukraine should be part of NATO, where an attack on one is deemed an attack on all. Anyway, Ukraine has been in civil war for a while, so it's quite possible that's why they haven't gotten into NATO. Okay, reason number 7 that we're seeing pain in the market right now is obviously bond yields rising. Bond yields rising on anticipation of the Federal Reserve's actions of not only increasing interest rates, but also limiting the stimulus that they are injecting into the economy, reducing their bond purchases, and then eventually they'll actually be vacuuming money out of the economy by removing money from the economy. Ultimately by selling bonds and then receiving cash in exchange for that, removing this from the market. It could actually, and Bloomberg expects this, it could actually take until the end of 2023, though, for tightening to actually begin, because there's so much excess liquidity that banks have, and you could see this by looking at the reverse repo market, as explosion in excess liquidity, which makes sense because in the bank earnings reports, we also had them talk about how There's so much money around, they might be pointing the finger at themselves. Reason number 8, the market is falling. Consumer sentiment has fallen to 68.6. This is down from 70.6, and this is the lowest read in a decade. Worries about inflation and Omicron are weighing on consumers. Now, sometimes the consumer sentiment reading can actually be lagging. That maybe we're overdoing the fear. But at least at the moment, in terms of the release that came out today, consumer sentiment has fallen. And you do have companies like Fox News reporting that 70% of individuals in America are unhappy with the state of the economy in America today. Number 9, Omicron mobility. We've obviously seen a massive decline in mobility data related to the Omicron surge. In fact, if we take a look at mobility data, we'll see that mobility has fallen so much substantially more than we had during the Delta variant's attack. So Delta was really a fall that we kind of saw around here. There we go. So around those green lines there, those are about the changes that you saw during the Delta variant. Actually not much, not substantial changes in mobility. Whereas take a look at this, TomTom congestion, Google mobility, and Apple mobility, all moving down substantially more for Omicron, probably because so many more individuals are getting sick compared to what we saw with the Delta variant. This is really quite unprecedented. Now, fortunately, we've been reporting this in the COVID update videos, we have been seeing an Omicron flattening in cases in New York City. So we're seeing some form of an inflection to the downside, but still a lot of lingering fear and pain over Omicron and what it might do for inflation. Consider the fact that a surging Omicron could shut down supply chains in China or in America simply by people calling in sick, not even necessarily with lockdowns, and that is expected to, of course, slow supply progress. Number 10 reason the market is falling. U.S. home sales had their largest plunge, falling 11% from a year earlier. This is the biggest decline that we've seen since June. Availability of homes on the market fell by 19%, leading to a 15% increase in the median home price year over year. This is now the largest median home price that we've seen in quite a while, $382,900. Number 11, shorts and hedges. Folks, people are so fearful in this market that the level of shorts, puts, and hedges against stocks throughout the stock market and selling to sit in cash on the sidelines has substantially increased. It's not a surprise when prices go down. Folks tend to be motivated to want to hedge their portfolios. Generally, the best time to hedge your portfolio is when prices are rising, not when prices are declining. But the most common time, not the best time, the most common time to hedge your portfolio is when when markets are going down, because this is when fear comes out, and this is when people continue to exacerbate the amount of short positions they have or put positions they have via options, and this can, in the short term, accelerate declines on stocks, especially if individuals believe that all of these catalysts are going to lead to a recession and potentially more pain for longer. Then hedging a portfolio is potentially a wise decision. Number 12, Germany's economy grew at just 2.7% last year, but folks, Q4 was a problem. We saw negative GDP growth and a fall of between 0.5 to 0.1%. I'm sorry, 0.5 to 1%. These are just the initial estimates for Q4. That's why we don't have an exact yet. But it looks like Germany will be having a decline in GDP in Q4, somewhere between 0.5% and 1%. And this could be because of lockdowns that came from Delta or COVID lockdowns for Omicron. But honestly, what the market feels like right now is just a continuation of March 2020 over and over and over again, as eventually maybe we get through this pandemic and we can try to go back to some semblance of normalcy. But otherwise, in the meantime, we've got a pretty sad market right now, a lot of fear, and all of this fear is just reiterated by rising bond yields. Again, a lot having to do with the Federal Reserve, but you can see there are quite a few catalysts here for why the market is falling. Also, the next time the Federal Reserve speaks will be January 25th to 26th. That's their next meeting. We'll expect a conversation from Jerome Powell on the 26th so we can get more insight from Jerome Powell directly. Anyway, folks, this is what's going on in the market. Thank you so very much for being here. Make sure to check out Titan via the link down below. And folks, we'll see you in the next one. Thanks again. Goodbye.